Hey, it's Joshua here with another edition of Mortgage Clarity, and today we're going to talk about FHA assumable mortgages. This is becoming much more of a topic nowadays that we're seeing interest rates rise, and there's a lot of sellers out there that have these very attractive low rates with their FHA mortgage. And so we're starting to see more realtors and sellers kind of market this in their listings. So I think it's important to understand what that means from the buyer's perspective. So let's just first talk about what does it mean when we say it's an assumable mortgage. Well, quite basically what that means is that as the buyer, if you qualify, you can assume or take over the existing mortgage that the seller who has an FHA mortgage has on their home. And that sounds very attractive because, again, you might be in a rate environment where rates are, say, 6, 7, 8%. But maybe you have an FHA loan that's at 3, 3.5%, 4%. And so there's quite a bit of savings on the payment if you can do that. However, there are some key things you need to know to find out whether or not this would work for you. The first thing is you must still qualify for the mortgage payment. It does not get around the process of having to make sure that your credit, your work history, your income, your assets, your total debt ratios qualify for an FHA loan. Now, one big drawback with these programs is that you must work with the servicer of the current mortgage. So you can't use the lender you like of choice. You're actually not going to really work with the lender at all. You're going to work with the servicer, and they're not lenders, which means this isn't something that they do on a regular basis. And so it's a much more complex and difficult process. I personally have helped people with assumable mortgage, or actually not with the assumable, but they had tried to do an assumable mortgage through a divorce or death. And throughout the process, after over 90 days of trying to work with the servicer, they just gave up and did a traditional loan because the process was quite difficult. So that's an important thing to know, again, is you're going to have to work with the servicer. Now, the other important thing is to know that you can only assume the amount of the existing mortgage. You can't add to it. So if you have a $300,000 loan, let's just say, that you're trying to assume, but that the seller's selling the house for $400,000, you have $100,000 you have to come up with because you cannot increase the existing mortgage for that. So that means now you have to go out in the market and you got to find a lender that offers a standalone second mortgage that they're going to allow to attach to that assumable mortgage as you do the loan process. Now, the servicers, they don't do loans. So now you're going to be stuck where you're going to be working with one lender to go through the underwriting process of the second mortgage, and then you're going to be working with the servicer to go through their process for the assumable mortgage. And so you're going to have to go through two sets of underwriting. There can be some additional costs with that as well. Now, another advantage of some of these assumable mortgages, you may not need to have an appraisal under that situation. However, again, if you're going to need a second to come in and help with that gap, you likely will. So that's the big takeaway there on these assumable mortgages for FHAs. While they do look attractive for rate, just be aware that you're going to have that extra underwriting process that can be a bit challenging. And unfortunately, you won't be able to go to your favorite lender to help you through that process there. If you have any other questions on assumable mortgages, how does it work and what does it look like? Feel free to reach out to me, throw comments down below. If you found this video helpful, please hit the like button, share it with friends and family, and don't forget to subscribe. All right, thank you so much and have an excellent day.